And Carter Worth at the Plasma has 3 charts we need to pay attention to. Carter, what are they?
Sure, let's start with the S&P. Now, just staring at that, that's a long-term chart. And I've drawn those lines not to manipulate your eye, but just to put in context, really nothing's happened yet, meaning we've just started if one wants to make a very unhappy case for equities. This is the great run of mid-1990s to the peak in 2000. We peaked on the 24th of March. It was a Friday. And you see that after we broke trend, it got pretty unhappy. This, of course, is the big run-up again, and we peaked in 2007. And after we broke trend, it got pretty unhappy. These are both 50% sell-offs. Now, it's inconvenient, but we have just broken trend. Those circles are each 20% down at the point at which I drew it. We're 20%. We know that from the peak to trough. Really, nothing's happened. If one wanted to put in that third red arrow, it would sort of look like that. Anyway, food for thought. Let's move on to gold and then one other chart. Now, there's a lot of tension here, and you can see it. I've drawn lines to maybe manipulate your eye, but just to show that we've worked into a point where something explosive is about to happen. There are plenty of people who believe that gold's going to break down. But what we know is, having been within this basically well-defined formation for quite some time, we are working into the point where there's a likely resolution. I'm bullish. I think gold resolves higher. It is also worth noting that the lows, equities are at a bull peak, and no one wants to talk about gold in 2000. Of course, gold peaks in 2011 when the stock market is crashing after the U.S. debt downgrade, and now the standoff, a 50% retracement. My guess is the green arrow is the right arrow to draw. And then finally, this is all sort of thematic. Here we have really the mess that is China. And China is hovering ominously right at a well-defined line, and it's my bet that we're going to break. And that would also then therefore get the red arrow. U.S. equities presumptively lower. This could be a part of the U.S. equity presumptive lower move. And gold, why not?
Carter, thank you.
Thank you.
Carter Worth, Cornerstone Macro, joining us. Mike Santoli's here as well, our senior markets commentator. He showed you the charts, but you think this is broader than just China?
Well, I think it's broader than just Apple and just China. So what's interesting is it's a little bit of a microcosm of what we have in the markets to some degree, right? Apple stock down a ton. Obviously, the market was sniffing out fundamental weakness, but then when you get the reality of it and you get the revenue guide down and you get by tomorrow the inevitable further earnings estimate cuts, the question is how much has already been priced in. And I think right now, the aftermath, who knows, Apple could finish higher tomorrow. We don't know exactly where it's going to go. But I think this is the fix that the overall market is in to some degree. And it doesn't have to resolve in a nasty way. Who knows what the forward chart's going to look like. But when people say, as a lot of people are saying with their year-ahead outlooks, that the S&P has already priced in flat earnings, or it's already priced in something close to a recession, that's easy to say right now. But the process of getting those earnings estimates coming down is messy. And so the market often doesn't necessarily get to that end point of pricing it in before you have some kind of confirmation of that.
We've gotten warnings from other companies, as we've discussed earlier, maybe the most recent being FedEx and Micron.
Yeah.
Do have to wonder whether this, in some respects, opens the floodgates now to more companies, more CEOs coming out and cutting their numbers as a result of the trade war and weakness in China and elsewhere.
Or at least it removes that psychological impediment to try to deny it, right? I mean, if Apple's not immune, none of us are going to be immune. So, yes, I do think that might be what we're in for right now. But again, you can't lose sight of the fact that the market has already made part of that adjustment.
But Mike, do you think the market, though, when we talk about China breaking apart, which I realize they've got a lot of money, I've said this for years, they've got $1 trillion or a couple $1 trillion to paper over their problems. But the ECB is possibly pushing Europe into recession a lot faster than the Fed is to us. Where do you see systemic risks right now? Because I'm worried about Europe, for what it's worth.
Well, I mean, I think you could see them almost potential ones wherever you look. I honestly am not even focused on that. I'm saying even if you don't have some kind of really bad accident in the financial markets where it is very systemic, you still just have to price in this further fundamental weakness, potentially. Again, I think this is the push-pull of the debate right now.
Yeah.
Because I think, in a short-term basis, a lot of folks saw the action in the last couple of weeks of December and said, wow, we got really negative in a hurry. We concentrated a lot of selling into a short period of time. Let's see if this can pass a test, if that's some kind of a decent low to trade off of. This is going to challenge the possibility of that being
Tim
the case.
Cook tonight validated in some respects the folks who got negative quickly, because Apple in its own right got more negative much quicker than people thought.
That's right. Well, and when it kind of runs in reverse that way, that's usually the way it goes. So I think you're right. So what does it mean? Does it mean that the market is not going to kind of give the benefit of the doubt that, in fact, bad earnings are priced in, or something weaker is priced in? So we're 14.4 times forward earnings for the S&P right now. That's if you get the almost 8% growth that is now the consensus.
Now that seems high.
It seems high. If you get 3% growth, you're up to 15 times earnings, which you probably would say is not that cheap, especially if you think the market is a 25 basis point, potential Fed error from people freaking out again.
Yeah, speaking of Fed and a possible error, let's bring in Joe Lavorgna, who's been writing and who's been talking a lot about the Fed lately. Joe, does this seal the deal? This keeps the Fed no more hikes for the foreseeable future?
Scott, I wish I could say yes, but boy, this Fed has just gotten so many things wrong, and hope, as you guys know, is not a good investment strategy. My guess is the markets are going to continue to punish the Powell-led Fed, lower prices, wider credit spreads, and eventually the Fed will relent. The question is when. The longer it goes, the sentiment can certainly feed on itself. When you have an economy where the financial sector is over 4 times the size of GDP, what the markets do is very important. It becomes very self-feeding and self-sustaining. If Powell is dovish on Friday, I think the markets could stabilize, but they really need to reverse course on this balance sheet and on projected hikes. And if they do that, Scott, then the fundamentals will reassert themselves. I just don't have a lot of confidence in Powell because what he's done recently is sort of flip-flop a lot. So the answer is I don't know.
But when the once biggest company on planet Earth, not that long ago, comes out and cuts a revenue forecast as dramatically as Apple has done, that has to get the Fed's attention.
But, Scott, it should. But, these guys tend to be ivory tower folks. Look, you've got a $10 trillion Treasury market where the curve is some parts of the curve are inverted, and the Fed says that doesn't matter. So, yes, anecdotally, Apple's certainly very important. China's weak. And, by the way, as you guys know, the U.S. equity market and growth was doing great through September, and then everything kind of unwound. Finally, they caught up to what the Fed was doing. So these anecdotes have sort of been there, but I just feel that this Fed is too model-driven, Scott, and I think that's going to be their undoing.
But the Fed, they've said publicly, in whether it was Jay Powell or whether it was Williams with Leisman in the days that followed that they had seen no sort of broad impact from this trade fight with China. Now they've gotten their real evidence from a company like Apple, which is one of the biggest consumer brands on earth.
It is, but here's the thing. They'll highlight trade as a risk, and Apple is certainly part of the China story, but they're looking at low unemployment. They're going to look at a decent payroll number, and my guess, and this is the wrong view, but my guess is they're going to say, look, the U.S. economy is still good. The fundamentals are solid. We don't need to panic yet. And this ultimately, Scott, would be classic Fed decision-making where it's too little, too late. It's a little bit like, you look at tech, you go back to the late 2000s. In November 2000, the Fed had a tightening bias in place. They went to an easing bias 5 weeks later, and then Greenspan cut intermeeting 2 weeks after that. So it's not unprecedented for the Fed to lag the markets. And you're right, they should follow what these companies are saying because it's real information. But they don't have a very good history of doing that.
Hey, Joe, it's Brian Kelly. So I'm curious, if Powell comes out on Friday, what would you consider a kind of a dovish view? Does he need to walk back the quantitative tightening, the balance sheet talk, or does he need to go so far as saying we're questioning whether or not we're even going to raise 2 times in 2019?
All of that would be great. If they do anything, he won't do that in my opinion. What he would say and what would be prudent is say, in light of the recent and dramatic tightening in financial conditions, we will take this into consideration when we next meet. That's all he has to do. So you've got shops out there who think they're going 4 or 5 times because they're Phillips curve fanatics. They could say, well, maybe it's not 4, maybe it's 2. People like me who don't think they should hike and they think they should ease, they'll be happy. I think he's got to keep it very broad. But, I don't know if he's going to do that because he could have said 2 weeks ago at the meeting, the drop in commodities and oil, and lower inflation gave them the leeway to be really dovish, and he wasn't. So I don't, I have a feeling maybe I'm a cynic, but I don't think he'll do that, but he just needs to do something. But, he's with Yellen, he's with Bernanke. It's probably going to be pretty consensual, and my guess is he's going to give us a whole lot of nothing, especially if the data on Friday are good, which I'm guessing they will be.
So, Joe, it's Tim. So back to the Fed and what they target. I mean, there's a time in which the Fed was really targeting asset prices in this country, and they really wanted to get them up. They got them up. And I think one of your core views is that this is really where you sit on the precipice of a major pullback when, in fact, asset prices are at this much of a cycle high going into a pullback.
Yeah, well, you had the genius of Bill Dudley in September when equities were down about 10%, saying it was effectively a tempest in a teapot. And, Bill's a nice guy, but he represents, to my mind, the way the board staff thinks about things. So, I mean, I just feel as if, the Fed is very model-driven. They're very focused on output gaps in slack. And when you get to economic inflection points, all that stuff you could throw out the door. It's just all about sentiment. And sentiment, as we're seeing, can change very rapidly. And Brian's point about the balance sheet is key. I mean, you look at last week, you guys saw a few weeks ago, when Powell said it was an automatic pilot, S&Ps dropped like 20 points within a second. So, I mean, that's the thing. I just don't think they fully get it. And
Williams did his best to try and walk that back 2 days later.
He did a little bit, but you know what, though, Scott? It's a little bit too late, and he's not the chair. That's the problem. They want to hear from Powell. This is a leadership. They want to hear from the Fed chair. They don't want to hear from an important Fed president. They want to hear from somebody who's actually perceived to be the person that drives policy.
Your point's well taken. Guy has a question
Joe,
for you.
real quick, what was the model for 8 years when they were keeping interest rates? Nobody seemed to care that they weren't model-driven when they kept interest rates at zero and let the stock market go up every day. I mean, I guess my question is, at what point do they have to sort of let the stock market stand on its own 2 feet and actually get us to levels where, forgetting about us today, the future of our dollar, in my opinion, is at risk when you have a Fed that's been accommodative in many ways. I think, well, not corrupt, but I mean, they just threw caution at the wind for 8 years.
Yeah, well, incompetence is probably the word you were thinking of, Guy.
Well, look, I didn't want to say that, but yes.
Well, I mean, look, Fed doesn't have a good track record. But the point is, the reason they were so accommodative was because unemployment peaked at 10% in the fourth quarter of 2009 and came down. And it was only been the last few years where the unemployment rate's been below where they think the economy is capable of generating unemployment without inflation that they've gotten worried. So, again, it's this unemployment and it's this flawed view, which I harp on time and time again. Low unemployment does not cause inflation. Mr. Powell, please, I hope you're listening.
Yeah.
Hey, Joe, we just spent the last 5 minutes talking about the Fed, but when you think back to what Apple just told us, how important is this trade situation and getting it resolved soon?
It's important, but to me, it's just the icing on the cake. Business cycles are all about liquidity and confidence, and that's always determined by the Fed. So the trade stuff, if you get some type of intermediary truce of some sense, because I don't think it'll last, that'll help. But the Fed has to back away. And also, you guys mentioned earlier about the ECB. I mean, you've got a few things happening all at the same time. I mean, the ECB not buying securities and the Italians going into the public markets for the first time in years, that could cause some big dislocation. So to me, the trade stuff's important, but this is really, in my mind, all about central banks.